All right, so stocks kind of had a little bit of a pause today after pretty dramatic moves last week, especially in areas like the Nasdaq 100 and regional banks and IWM as a result of that, and some moves in bond yields, especially really dramatic moves to the downside, especially in some of the very short-term yields, 3 month in particular. So we're going to break down kind of the rebounds in some of these areas, and what we expect to see. What our expectations were before we've had this little mini financial crisis, and then now that it appears to be settling, is that now going to lead us towards a bullish expansion, like maybe what the Nasdaq is showing us? So we're going to take a look at the indicators on the Nasdaq and how they compare to the indicators on, say, like the Russell 2000. Which has really been influenced by the financial sector, and then the S&P, which is almost smack dab in the middle, to try to gauge what our expectations are now that this crisis may appear, at least on the surface, to be over. And we can settle down there and get back to either, again, like I said, a bullish trend, or get back to what was leading people to be bearish since that early February peak before these banks became an issue. So we're going to break all that down in the video today. What's leading the markets, which sectors are moving today, and pretty much a function of last week again too there. And then our trade idea is a stock that had been moving, that appears to be kind of moderating itself. So we're going to talk about how to trade that. And let's go ahead and get started. Today is Monday, March the 20th, 2023. This is the Market Outlook for MarketScholars.com. My name is David Settle. All right, before we get going too far, I invite you to subscribe to our YouTube channel with this icon or the red subscribe button down below. Click the thumbs up icon to like our video. Comment on anything that stood out to you today. Join our website at MarketScholars.com for free. Follow me on Twitter for more content between the videos from day to day, and join our Market Outlook Facebook group that we've created. All right, if you're watching us here on our blog, check out some of these other things over here on the right, including our Market Outlook live videos that we do at 3:30 Eastern Time for our subscribers to our website. Come down here to the bottom, click that heart. Look at that, 122 likes. That was big time. So again, thank you all very, very much for doing that. When you click that heart, it opens up this tab. Hit that like button. Same thing with that thumbs up icon. It opens up this tab. Hit that like button. 20 likes actually is pretty good for what we've had before on the Facebook page. So thank you all very much for those who like this day in and day out. Getting above 100 is a big deal for us. That's why we always ask for it. It helps get our content out to more and more of our followers on these platforms. So thank you to those who click on these day after day. And for those who don't, you can do right now with 1 or 2 easy clicks while you're watching the video. All right, let's take a look at the S&P 500 with the market forecast indicators. You can see the intermediate, we did rally today. It was a small range, as small as Friday's was. It was even smaller today. A couple of smaller than average ranges going into and out of options expiration. Of course, we have the Fed meeting, FOMC meeting, and their rate decision here later this week. You notice that we did not clear above this high point on this really strong day we had on Thursday. The near-term line, which again exceeded the momentum line, is rolling down. The momentum line's already down. The momentum line is rolling down. As you can see, we are still 1.5% below the moving average. So we have light green shading in a red line. We don't have the yellow line until we actually cross above a falling moving average there. But we are far enough down that we will get, some kind of bear tag at some point, like we probably almost did right there. Similar setup, that light green shading and the yellow line. The only difference is that yellow line was actually rising there, and we finished below it instead of crossing above a falling moving average. Regardless, you can kind of see that that's not the case for some of these other indexes. The Dow, the near-term line, the momentum line did spike up, and we did have a couple bigger days today. Almost about an average day. The intermediate line, though, is lower, has been in the reversal zone for a good chunk of this time, and the market sentiment line is significantly lower. It's actually falling. So we have been a lot more bearish on the near-term line, and you can see, but the near-term, on the intermediate line, but the intermediate line, you notice, or near-term line, I can't get these two straight. The near-term line is not getting in the reversal zone. So the momentum line did, the near-term line did not. Again, if it were to peak here and roll over, that would be a bearish near-term level. The Nasdaq, on the other hand, when you look at the Nasdaqs, the near-term line did get in the reversal zone, got well up to extreme highs. Again, did not, the momentum line did not take it there. and it far exceeded where the momentum line got. The momentum line didn't even get in the reversal zone. So that's a little bit of a concern. Kind of shows that maybe we were a little way too bullish here on. So that's something to keep an eye on over the next couple of days to see if this ends up being a pretty significant fake out pattern, as is generally the case when the near-term line exceeds the momentum line like that. The intermediate line has crossed over into bullish territory. It's the only one that has now moved high enough. We are almost 2.5% above the moving average. But the momentum line is pulling down, and so we'll pull that near-term line down too. So that's an important thing to watch over the next couple of days, especially with that FOMC announcement coming. Then you can see the Russell, which has by far been the most bearish, with more of a significant link to the financial sector. Also a lot less bullish today. So a little bit of a long upper shadow. The near-term line did not get into bullish territory at all, and is already easily in bearish territory. Your market sentiment line is falling. This has been it was an outperformer until this last couple of weeks. So your market sentiment line is higher than it is on some of the other indexes, though it's close to dropping below 60. So we'll see how long, especially with the intermediate line still in the reversal zone. We'll see how long that lasts. This is a pretty significant drop, 7% below the moving average, far exceeding how far we got down to in the last low point here. And not necessarily matching how high we got above it on that kind of fake out pattern on that February 2nd, where we got the exhaustion gap on so many stocks and indexes. So that's kind of what the market forecast charts are looking like for the different indexes. Let's take a look now at some of these other oscillators. Let's look at this chart. You can see, again, we got a lower close and a lower low last week. Not this week. So far this week, we're nowhere near a lower low, and we have a higher close. So we are setting up for a transition candle this week that would transition us from what was a little bit longer, but still pretty darn short bearish trend to now a bullish one. The PPO is still negative, so we still have a death cross and still falling. If you take a look at the NASDAQ, remember that's the most bullish index. We are back last week. We did get back up above. We've got multiple transition candles here, but we just can't close above the body. Well, this would be the reversal pattern. So after a green arrow last week, we got a reversal pattern here, and you're that close to a golden cross on the NASDAQ. So your NASDAQ's really kind of leading the way here, trying to get that move back up to all-time highs, right? That everybody's been expecting for so long about how bullish we are. And the NASDAQ's trying pretty much by itself right now to make that happen. Because you remember, on the other hand, the Russell 2000 is not nearly as bullish at all. I mean, it doesn't have a lower low this week, but definitely has a lower close, and obviously an easy death cross here, and bearish Heikin-Ashi differential. Like we are very bearish on the Russell 2000, so nowhere near turning higher. The Russell and the NASDAQ are on a clearly divergent paths. Looking at the 3 green arrow chart, we have 3 green arrows for the Qs. Again, goes to show the divergence here. 3 days now too, but only 2 on the. We finally got the second one today on the S&P. We finally got our first green arrow on the diamonds today, and we actually still have 3 red arrows on the Russell 2000. So it goes to show just how distinct these are. These two, we have 3 green arrows for 3 days. We have 3 red arrows still for quite a few days. And then your S&P and your diamonds are just barely getting green, first and second green arrows. So the NASDAQ really is on its own path. That the Russell 2000 especially just is not following. Again, mainly because of its link to that financial sector, which is just getting hammered right now. Looking at the DMI, you can see the negative indicator is dropping back down. Hasn't dropped below 25 yet, but is working its way down there. The positive is above 20, not back above 25 yet. So we're still negative. But we're not nearly as negative as we've been. IWM, of course, has been, right? We are easily above 25, still below 20. Your ADX is actually still rising there. So definitely a bearish trend on that perspective. Looking at your stochastics, we are above the moving average on the stochastic, so we are right smack dab in the middle of the 4-week range. So that's actually, again, we're only kind of dipping our toe, but getting above 50, see, we only dipped our toe there too. getting above the 50% mark is a significant deal. Getting above 60, getting above the moving average is significant. Getting above 50 is kind of a next step. Getting above 60 would be kind of like your final step there. So we're kind of working our way towards being pretty bullish here on the S&P. Your NASDAQ, remember, is. I mean, look at, we are really close to a 4-week high point. We're right there. The Russell 2000, on the other hand, is not. So, I mean, the S&P is the exact middle of a really bearish Russell and a really bullish NASDAQ 100. Your NASDAQ, as we've talked about before, has been behaving as a safety trade. Here's your S&P, a weak bearish trend still. You're below the cloud. You're below the blue line. You got a strong rate of change to the downside. Your Russell 2000 is like that close to having a very mature bearish trend going, being below -5, being above 80. And then on the other hand, your Qs doesn't have a trend at all right now. It was bullish, has not been bullish for a while, has been pretty sideways, but at least you are above the cloud. You do have a negative rate of change, so that's an issue, right? That's you can see that's a reversal pattern when that's one sign of a reversal when you start to have a 26-day, a negative 26-day rate of change there. Or excuse me, you're actually positive. Sorry, your price is now below that level. Getting above here means that price now is well, actually, excuse me, no, our price now is way up here. Here's where we're at. I was going to say the red. There's that red line right there. There's where we're at. We're missing all this last week's move. We do have barely a negative a positive rate of change. We're barely above those highs. We're not even above the close. Excuse me. We're not above the highs. So that's how tenuous we are in terms of getting the Qs to a negative rate of change, which, as I mentioned, would be the first first sign that we are changing the trend. Your Bollinger Bands on the SPYs have moved back inside the Keltner channel, so we're starting to go sideways again. The Bollinger Bands pointed lower at near this 150-day lows. We are in the middle of the range, a little bit in the bottom half, but we are in the middle half. We're below the point of control. That's still acting as a resistance. And as I mentioned, we have the red arrow. So, if we were to break through here, you can see how significant that would be. Of course, your Qs have a very low bandwidth, and we are breaking out. Like we did get above 100 there a couple days ago. And you can see we're not above the Keltner channels, and we're still easily below that. But and the bands are inside the Keltner channels. But we did, for one day, break outside of the Bollinger Bands. That's pretty significant for the Qs to the upside. The diamonds, on the other hand, we actually broke down out of the bandwidth to the downside and are still easily in the lowest quartile of a very strong bandwidth, right where the point of control is, and still trading near the point of control, or the Keltner channels. Have been trading outside that range. Very strong trend. The bands are very wide outside the Keltners. So, we are on a downward trend for IWM, whereas the Qs appear like they may be trying to start a bullish trend, but not quite there yet, not like the IWM is, again, to the wrong direction. Looking at today's range, you can see, again, I told you it was an inside day inside of an inside day, so 2 consecutive inside days. But we did finish near the high of the day, so that's a positive sign, and we did get a slightly higher low. We are, again, near that midpoint, so we're not breaking out. The green line moved up significantly because now the high point, after this jumps off, the high point is going to come way over here. So you have a very, very high green line, but not to 100, right? We've got to break above this high point to get 100, and that would be a significant change, and very well could happen, if we don't get a new low point anytime soon. But again, you can see we got a lot of resistance above us and not very much support below us. So wouldn't be surprised if we did get a new low by the end of the week here. More likely to get a new low by the end of the week than we are to get a new high by the end of the week. But if we don't get a new low by the end of this week and we stay in the upper half of the range by Friday, then we'd be really close to a breakout by next week, right? So again, that's I think that's a lower probability, but that is a possibility if we don't get a new low and we stay in the upper half of the range of this 4-week range by the end of next week. Looking at the volume, you can see it really dropped off, 92 million. The range also dropped off, only 4 points. So we really dropped off here. There's a 4-point range is below the 52-week average. 92 million is way down here below the average too, and they had really jumped up. We had easily jumped up about 1.5%. So not necessarily what you'd like to see. You like to when we got these bullish moves and strong Bollinger Bandwidth and strong moving average here. You'd like to get strong upward moves, right? Because that's getting the strong upward moves when you're coming off these lows is what helps get the money flow back up to where it should be, right? To where it kind of needs to be to support a bullish move, and we're just not there yet. Again, you can see here's where the money flow is at these peaks. Like for example, that peak right there, we're not very far off that peak, 5 points, and you can see we're nowhere near the money flow because we can't get going to the upside. So here's we've been gradually moving up higher and higher, but the volume's actually been kind of stagnating, and we're easily in bearish territory. So we just can't get going here. We can't get that nice, good, solid reversal pattern to get the MACD going above its moving average, get the parabolic SAR flipped. We have the red line now in the 200-day haul as well as the 20-day. So we are kind of rolling back over again and not necessarily breaking out quite yet. Your McClellan oscillator is easily still below the -35 mark. So as bullish as we were today, we're still showing pretty negative breadth with the summation index that's falling rather sharply. And then you look at the new highs and new lows, they remain rather bearish. You can see below the moving average at -320 so far here. So the breadth still and the volume is still not supporting any kind of rally here, and goes to show that this rally is just more of a consolidation setup for a continuation of what my opinion is of this bearish move that we've had. Finally, one more chart to look at is the VIX. You can see the VIX. We are down today, down to 24, but still in neutral territory, still very strong. Correlation with the VVIX, which is also down today, but still at high levels. So you can see higher than what we had in September and October when we were at those lows. So very, very strong volatility levels, setting us up for a potential continuation of this strong VIX move above these moving averages, right? We're still above the 8-day moving average, as bearish as we were. So we need to kind of break these lines if we're going to really break this volatility move and start moving lower. Otherwise, we just take advantage of these declines for this. You can see the last couple examples, the successive rallies, considering especially where the VVIX is, and how high it is, and how high you would expect it will remain to be. See, these other peaks didn't even barely scratch the surface above their 200-day moving average. This is the first time that we've really broken above the 200-day moving average for quite a while, when we really changed the direction of the VVIX back here in the middle of 19 that ultimately led to the COVID setup there. And then, of course, same thing over here. And in fact, if you look at how far above the 200-day moving average we are for the VVIX, you can see we got up to a higher level than we've seen since COVID. So I think we are in a pretty significant regime change, as you saw there. This with the regular MACD, the 8 and the 17 exponential also getting to one of its higher levels that we've seen again since COVID. So in my opinion, a significant change in direction. We have been in this consolidation period, this compression period for volatility. I think we're going to be now in more of an expansion period. It's going to be ups and downs, but I think we are more of an expansion period in volatility going forward from here. All right, now let's take a look at what's driving this action. You can see we're pretty much consolidating some pretty big moves that we've had over the past week or so, especially in the Qs and gold. Gone pretty sideways. Commodities have been down. It's going sideways. So that's kind of what we're seeing here. When we take a look at just today alone, we'll go March 20th here and just go a few minutes on the chart. You can see, again, these are relatively small ranges. The S&P is up a little bit less than 1%. IWM rebounded. They had a really down week, rebounded 1.25%. The Qs had a really strong week. We're flat today, coming off of lows. The dollar was down today, helping lift risk appetite, developed markets, not so much in emerging markets. And then, of course, long-term bonds dropping after yields really plummeted. You can see yields rebounded in a big way today. The 3-month yield jumped up to 4.64%, up 18 basis points. Again, it's not common for the 3-month Treasury, because this is essentially its effective Fed funds rate. It's not common for it to be this this volatile, and you can see it's really rebounded up after tanking over the past week. It was up at 5%, over 5%, and then it dropped down to less than 4.5% last week before bouncing back up here today. You can see that's the 3-month. The 2-year rebounded as well, trying to get back above 4%, and then the 10-year, which had also fallen below 3.5%, not bouncing up as much. As a result, your spread dipped a little bit today after just, look at that tremendous rebound last week. And then, of course, but that's that spread. This spread still remains at extreme lows, dropping 10 basis points today, about as low as you could get. I mean, it had started to rebound the last couple of days before dropping back down. Again, this is a really, really low level. And again, the expectations for a rate hike going into what this would be Wednesday or Thursday here, March 22nd. The expectations are still pretty darn high. 75% odds that we'll get a rate hike to 5%. About a 40% chance we'll get another rate hike in May to 4.25%. That's been a lot higher than this. It was at 90% a month ago. Now it's only at 43%. But still, it had dipped down to 20. I saw sometimes it was at 0. So getting back up to 43% is pretty significant. The question is, of course, when's that next rate hike or rate cut going to be? And you can see as of right now, you're still about 60% chance by June of being at 5% or higher. Because again, remember, we're high odds of getting at 5%. By the time we get to September, however, you can see we only have a 96% or 4% chance of being at 5% or higher. So we have a 96% chance that we get our first rate cut by September. And of course, by December, you're looking at a 99% chance of a rate cut, a 90% chance of 50 basis points of cut, and then about a 70% chance of 75 basis points of cuts. Again, a month ago, that was a 0% chance, and now it's at 90, right? 90% chance of being at 4.5%. We were, pretty decent high odds. We had a 94% chance of being at 5% or higher. Now it's only 1. So things change pretty dramatically, and this is the most important thing, right? if what happens next week is kind of getting baked in the cake, but what's going to happen by the end of the year? When are we going to get those rate cuts? That's really kind of what the market is looking for. Again, the Fed won't cut rates just because, right? In the past, they've kind of done that because of these yield spreads have been so negative, and the Fed funds rate has been negative too. So they've done that in the past in order to keep the Fed funds rate negative, but the real Fed funds rate negative. But they have told us here that they're not stopping until the real Fed funds rate is positive. So if they're going to cut rates, it's not going to be just because, right? We have inverted yield curves, and they kind of feel like they have to. They will feel like they have to, but it will be because we are deep into a recessionary time, and they're going to be late even starting it then. So again, if we are going to get rate cuts, I know like in 2019, rate cuts were really good, and the market rallied and felt until COVID, and the market felt great. But that's not going to be the same case here, right? We are in a much different environment, much different situation. We had a much lower real Fed funds rate than we ever had in 2017-18. The inflation's still very high, so they do not want to cut rates anytime soon, not until they feel like they can get this down below. Remember, 5% appears to be the peak of where the Fed funds is going to get to. So that means the CPI has got to get below 5% for us to even have a positive real Fed funds rate to any degree. And that, again, with how things have been moving here lately, appears to be unlikely. Now, we will get this next month, here in March, you notice the year-over-year rate, you can see at 0.3%. The year-over-year rate is expected to drop to 5.25. So we're getting closer, right? At least we're below 6. The core CPI, this is actually an increase from what it was in February. So the problem is the core rates and all these levels are still moving higher, even if the headline rates are moving down. So that's still an issue, and that's why, again, I would not be surprised if the Fed raised rates easily by 25 basis points. I don't think they'll do 50 anymore because they don't like to shock the markets. But what they say is probably going to be the most important thing. And if they continue to reiterate how important it is to get inflation in check, and that they feel very good about the financial situation, then again, going into this financial situation, we had been bearish. The market had been pricing in the Fed being more hawkish, and that's going to be what we're watching for. And I think a lot of people that have been buying the Nasdaq lately have been hoping that the Fed will be a lot less hawkish than they have been, and start dialing it back because of this mini financial crisis that we've been in. Let's take a look at some of these charts. Remember, the dollar and bonds kind of had a big move today. Let's look at the dollar's move. Dropping below the 30-day moving average. The MACD is negative. Stochastics is down. We're at the point of control. It's still trading in between the 30 and the 50. But you can see how tenuous that dollar move is. But you can also see the potential that it would have of just bouncing right back up. Same thing with bonds. This drop in bonds is not that big of a deal. Now, granted, we had a pretty big jump, and that's probably bigger than probably we should have had. There's some significant resistance at the 200-day moving average. This Fibonacci level of this decline we've been on, as well as the point of control. I think we'll probably stay more in this area. I don't think we'll get to strong new lows. Maybe a little bit lower than these, but I don't think we get to new lows past this level. I think we trade inside this area until we get to the point where the market is in full-on bear market mode, and we're not quite there yet. As you can see, we are still, trading around the 200-day moving average, but easily above the 200-week moving average, and trying to actually get back above the 30-week here. And the Russell 2000, which had broken the 200-week, rebounding slightly, but still easily below the 200-week, and now your 8's crossing easily below the 17, and they're both crossing below these three different lines: 30, 50, 200-day, 200-week, moving averages. You'd expect that that's where everything else is going to lead. The Nasdaq, on the other hand, with last week's move jumping up above all these lines and pretty darn bullish, right? The question is whether it can extend away from this line, which it was unable to do last time it tried to break up above. So really important week for the Nasdaq here. Let's take a look at the sector moves. So let's come down here to the sector comparison chart, and let's just take a look at today. Remember, we've been kind of consolidating those strong moves in the Qs and negative move in IWM. Well, that means these sectors that had a bad week last week: materials, industrials, financials, energy, they all did okay. Staples and healthcare also kind of wrapping up here. But sectors that did really well last week: XLK, XLY, XLU, because of the interest rate sensitivity, lagging behind. So they were up barely, but lagging easily below where the S&P was. So basically today was just a kind of a breather move from what we saw last week. And the question now is, what will we do coming out of this? Of course, that's the big question mark, and a lot of it's pointed towards what the Fed's going to say and do. And again, my expectation is what it has been, because I haven't seen any evidence yet to tell me to expect otherwise, that we'll continue on this bearish decline and this move on the Nasdaq, which has been so tremendous relative to the Russell 2000 on a relative basis here. Let's look at the Qs relative to IWM. That was such a parabolic peak that I feel like we're going to start to pull back from now and start working our way down. The MACD, every one of these indicators is extremely high, and I think that's more of a fake out pattern that we're going to correct and work our way back below and get to back where we were before this crisis erupted, and be bearish for other reasons besides the fact that some of these smaller regional banks are failing. All right, now let's look at our trade idea of the day, and let's take a look at Walmart. Walmart has been Kind of up and down, just pretty much as everything has been. Mostly down, as you can see, lots of dark pink shading and a red line, and we're starting to slightly move higher. The intermediate line crossing in above the market sentiment, still in bearish territory, coming out of the reversal zone. Short-term sentiments relatively bullish, kind of looks very similar to the S&P. Light green shading, red line still because we haven't gotten above the moving average, but we're not very far away. We're only 1/3% there. And if you look at the long-term line for Walmart, you'll see that we are, we have been some bearish candles, but we're not only getting a higher close. We got a higher low last week with a lower close, but we're getting a higher close this week and potentially closing above this candle, which would be reversal. So it'd be a transition and a reversal all in one. And you see how close we are to crossing above the 10-week moving average, which would give us a green arrow. So things are looking much better than they have been for Walmart in a while. We got above the 17-day moving average, the rising MACD above its moving average. So Stochastic's also easily above its moving average. So momentum is turning higher. Though you notice we are still in between moving averages. We haven't crossed above multiples, which is what really breaks us out. And you also have this point of control here in this area too. That's also a limiting factor in terms of how far up we can go with this momentum that we have. The DMI, both the directional indexes are below 25. You do have bullish crossover, but they're still really low. So we don't really have, a big bullish breakout there right now. Looking at your RSI and the CCI, again, above 0, above 50, but you have to, neither one of them are confirmed with a break above 60 or a break above 150. So we're still in neutral levels from that regard. Looking at the Ichimoku cloud, we're trading below the cloud with a slight negative rate of change. But whatever bearish trend we had is gone. So, we don't have a trend anymore. We're trendless, so to speak. And you can also see that too here on the Keltner channels. The bandwidth is falling already at relatively low levels of a really tight bandwidth, with the lines coming inside of the Keltner channels now, which typically means that we're going to probably gravitate around this point of control in a sideways action for a little bit of time at least. So what that generally means, the setup for that is generally to look for a iron condor spread. So I sold the 134, 20 deltas, bought the 132 for protection, sold the equivalent delta over here at 147, bought the 149 for protection. So that's a full position size because you don't have to worry about the earnings. Full position size, pretty decent return. Those break evens, you notice, are outside of the Bollinger Band. So to break out of these break evens, the bands would have to really expand, which would mean we'd have a trending move, which we don't want to be an iron condor anymore if that's the case. So I like where our break evens are. It doesn't look like we'd get stopped out on a whim, and as long as we can stay in this area, then we can make the return, pretty decent return for the amount of risk that we're taking there. All right, well, that wraps us up for today. You've heard from me now. Now I want to hear from you. Use that link popping out in the top right corner of your screen. That takes you to our Market Outlook forum. Open up any new thread there with any questions or comments you have. Reply to anybody else's thread, and let's keep this conversation going in between videos. Again, thank you very much for watching. Remember to subscribe to our YouTube channel, hit that thumbs up icon, comment on the video. Join our website at marketscholars.com for free. Like us and follow us on Twitter and Facebook as well. Have a great rest of your Monday night, everybody, and we'll see you all next time.